Hi, and thank you for joining me for this Alexforbes Active Balanced High Growth overview of the last quarter in 2022. So, as we know, portfolio is in the multi-asset class range, and these portfolios have an allocation to more than one asset class. In most cases, these asset managers that have been selected allocate investments between equities, bonds, cash, listed property, and other asset classes based on, for example, their risk and return outlook for each asset class at any given time. The managers aim to add value through active asset allocation by overweighting and underweighting the asset classes and through active security selection within each asset class. As stewards of clients' capital, we are guided by our own risk-led philosophy in the pursuit of superior risk-adjusted returns across all our platforms. We take a holistic view in our investment approach, ensuring that we have portfolios that are purposefully diversified, which can deliver superior returns at a lower risk to that of the market. In the past, our portfolios have experienced minimum drawdowns in down markets and participated during market rallies to deliver client outcomes in line with our risk-based investment philosophies. What we can see here is that we have 91 M&G Investments, Allan Gray and Truffle, and Aluwani as the local mandates, and then Mercer as the offshore mandate, with local alternatives and Africa coming in at 1.3% and 7.5% respectively. Performer has outperformed the benchmark for the quarter. An environment has been affected by geopolitical risks due to the Ukraine-Russia war and was negative for global asset classes. The portfolio was outperformed by the benchmark, has outperformed the benchmark for the year in a strong market driven by the JSE. The portfolio is ahead of its CPI plus 5% objective for the 5-year period at the end of March 2022. In addition, the portfolio has an 85% success rate in achieving its inflation target over a rolling 5-year period since inception. Both asset allocation and share selection contributed to outperformance for the quarter and the year. Tactical changes over the past 12 months resulted in an underweight to offshore equity, which contributed to relative performance. Performer's relative position to his peers was underweight, and offshore equities during the period and overweight domestic equities on average, which benefited relative performance in an environment where domestic equities rose while offshore equities tumbled due to heightened geopolitical risk after Russia invaded the Ukraine. The domestic balanced asset managers delivered positive absolute relative performances over the quarter. Asset managers with high exposure to equities and held resources delivered positive outperformance over the quarter, and all managers delivered positive alpha for the quarter, with Aluwani and the highest and Allan Gray the lowest. Aluwani, in the first quarter of its inclusion, the manager outperformed its Alexforbes South Africa Large Manager Watch benchmark, driven by asset allocation of being overweight equities and bonds and underweight property and cash. The manager's role is to capture upside in the market rally, mainly during up markets. Within equities, the manager had an overweight exposure to resource shares in Sasol, Impala, Sibanye, and Nedbank, which added to performance. 91 brings revision to the portfolio, and we can see that asset allocation added due to an overweight exposure to equity and underweight in cash, and holding resource and financial counters also contributed to their performance in the period. Truffle outperformed due to their stock selection with large and small mid-caps in the market in an environment where risks were elevated globally, and the manager increased its cash position to improve protection. It was also overweight in ABSA, South 32, RMI, and Rainnet, and added to relative performance. M&G outperformed due to their asset allocation of being overweight equities and underweight cash, in line with its value style and value rallying over the quarter. The equity selection was positive, and we see an overweight allocation to SAPI, Sasol, Investec Limited, and Glencore, which added to their relative performance. Allan Gray brings value to the portfolio, and its outperformance came as a result of stock selection in a market where dispersions were high among shares where value was as a style outperformed the capped SWIX, and we see that holding Sasol, Glencore, and Standard Bank really added to the relative performance over the quarter. The exposure to domestic hedge funds contributed to the absolute returns and outperformed the performer benchmark in a strong South African equity market over the past 12 months. In particular, the equity hedge component performed better than fixed income hedge strategies, led by long-short bias managers benefiting in an upmarket. For the quarter, hedge funds were also positive and added to the alpha of performer in an environment where the offshore component was negative. Africa detracted to relative performance, driven by lower returns from key regions such as Nigeria and Egypt. In addition, concerns around rising inflation, geopolitics, and stronger rand detracted from returns. Global. Over the quarter and year, the offshore component performer international lagged its peers and detracted to the portfolio's return. Within the offshore component, growth asset classes were negatively impacted by the rising interest rates, inflation concerns, and poor sentiment due to the Russia-Ukraine war, and lagged offshore government bonds and cash in a strong environment. An overweight to technology sector and underweight energy and materials detracted from value. Holding high-yield bonds and global cash helped to protect slightly in a falling in global equity market as these asset classes fall less relative to global equities. In quarter one, a decision was taken to tactically reduce offshore equities by a further 1% in favor of the Mercer diversified growth, with the aim to manage the risk in the portfolio. This decision added as global equities continued to fall. The global diversified strategy benefited from exposure in real estate and bonds in emerging and developed markets. The strategy provides downside protection in periods of market volatility due to its lower beta to the market. Thank you so much for your time, and thank you for listening to this vodcast, and I hope you may join us next quarter for the same vodcast as well.